Here is the judgment up front. The iron ore story in 2026 is not primarily about China demand. China is the obvious variable, the one every analyst leads with, the one already baked into share prices. The more dangerous variable, the one that could structurally reprice the entire sector's margins, is what Fortescue said quietly last week about fuel costs and the Iran conflict. That is where this analysis begins. Let us compress the week's events first. BHP paid out $5.2 billion in dividends on Thursday, and a further $3,900 million is due from Fortescue and others next week. That is $23 billion in total dividend flow back into the Australian market over a fortnight. Analysts at AFR flag this as a potential catalyst for a share market rebound if Middle East tensions continue to ease. Rio Tinto secured a $2 billion government deal to repower its Boyne aluminum smelter in Queensland over the next 10 years. And a smaller iron ore miner, Fenix Resources, is navigating a cyclone closure at Geraldton Port while maintaining its full-year guidance of 4.2 to 4.8 million tons of sales. Those are the cards on the table. Now let us talk about what they mean. The number that should be stopping investors in their tracks was buried in a Reuters report cited by multiple outlets this week. Fortescue, the company that perhaps understands Pilbara iron ore economics better than anyone, said iron ore miners could face billions more in fuel costs as a direct consequence of the Iran conflict. Not millions, billions. Think about what that means structurally. Iron ore mining is one of the most fuel-intensive industrial operations on the planet. Haul trucks, excavators, processing plants, port logistics. Diesel is the lifeblood of every ton moved from the Pilbara to a ship. Fenix Resources mentioned it directly in their operational update: potential diesel supply disruptions from contracted providers due to the Middle East conflict. If a junior miner with 4.5 million tons of annual sales is already flagging diesel supply risk in operational updates, what does that mean for BHP moving over 250 million tons a year? The consensus view on BHP right now is that Morgan Stanley's overweight rating and $56 price target tells the story. 12% upside, strong, fully franked dividends of approximately $2.05 per share in FY 2026. That is the comfortable read. The uncomfortable read is that BHP's cost base could be facing simultaneous pressure from two directions at once. First, the fuel cost shock that Fortescue openly warned about. Second, and this is the part that received almost no analysis this week, BHP is now facing its first strike threat in the Pilbara in decades. Roughly 60 high-voltage electricians, whose work is essential to keeping power running at mine sites and camps, voted for protected industrial action after what the Electrical Trades Union described as a year of stonewalling in negotiations. 60 workers sounds small, but these are not general laborers. High-voltage electrical workers are a choke point. A mine site without reliable power is not a mine site. The timing, during a period of already compressed margins from softer iron ore prices, is not coincidental. It is a signal that the labor cost cycle may be turning. Now here is what Rio Tinto's week actually reveals when you read past the headline. The $2 billion Boyne smelter deal is being reported as a win. Government support, green transition, future-proofed aluminum production. But Renew Economy reported something the mainstream coverage glossed over. Rio Tinto has effectively farmed out the smelter repowering and simultaneously shut down its internal decarbonization division. Read that again. The company that was supposed to be leading the mining sector's green transition has dismantled the internal team responsible for executing it at the exact moment it announced a major decarbonization project. What this tells a careful observer is that Rio is not betting on its own decarbonization capability. It is outsourcing the risk while capturing the government subsidy. That is a financially rational move. It is also a signal about where Rio's capital priorities actually sit. The aluminum business gets the government-funded green makeover. The iron ore business, still the earnings engine, is being managed for cash generation in an uncertain demand environment, not for transformation. Here is the reversal card. Most analysis of iron ore in 2026 treats China demand as the swing factor, and everything else is noise. But consider the convergence happening right now. You have a fuel cost shock from Middle East tension. You have labor action threatening Pilbara operations for the first time in decades. You have a junior miner, Fenix Resources, that Bell Potter rates as a potential 90% upside play, precisely because it has lower C1 costs, an integrated logistics network, and the largest storage position at Geraldton Port. Why does a small miner with 33-cent shares get a 90% upside call, while the majors trade at a fraction of their potential? Because in a cost-pressured, margin-compressed environment, operational efficiency becomes the differentiating factor. The market may be beginning to reprice not just iron ore exposure, but the quality of that exposure. Low-cost, integrated, strategically positioned operators start to look very different from high-volume, high-cost, geopolitically exposed giants, even if the giants carry the famous brand names. The point most people are missing is this: the $23 billion in dividends flowing back into the ASX over the next 2 weeks creates a mechanical buying pressure that could mask the underlying structural deterioration. Investors receiving BHP's $5.2 billion payout may reinvest it into the same beaten-down mining names, creating a temporary floor. That floor is not a recovery signal, it is dividend recycling. Confusing the two could be expensive. So where does this go? There are two credible paths from here, and it is important to hold both simultaneously. In the first scenario, Middle East tensions de-escalate materially and consistently. Diesel supply normalizes, the fuel cost shock that Fortescue warned about does not fully materialize. China's property sector stabilizes, not booms, stabilizes, and iron ore demand holds in the range the market currently expects. In that environment, BHP's dividend yield is genuinely attractive. Morgan Stanley's $56 target has a clear line of sight, and the labor dispute at the Pilbara gets resolved through a wage settlement that adds a modest amount to the cost base. The $23 billion in dividend recycling becomes genuine re-rating fuel. Rio's Boyne deal looks prescient. Fortescue's automation push with Caterpillar, the pair renewed their autonomous haulage agreement this week, starts delivering the cost savings needed to offset margin pressure. In the second scenario, the Iran conflict does not de-escalate. Diesel costs move structurally higher for an extended period. The Pilbara strike action broadens, or is resolved but sets a precedent that lifts wage expectations across the sector. China's stimulus measures disappoint, as they have repeatedly over the past 2 years. In this environment, the majors face simultaneous margin compression from costs and revenue. The dividend forecasts, BHP's estimated $1.80 per share in FY 2027 versus the current $2.05, reflect an already expected decline. The actual number could undershoot that consensus if cost hit harder than modeled. And the operators with lower structural costs and strategic port positions, the companies that Bell Potter is quietly flagging in research notes this week, begin to draw capital away from the household names. The single most important variable to watch between now and the end of April is not the iron ore spot price. It is whether Fortescue's fuel cost warning translates into actual guidance downgrades at the next quarterly production report. If the majors absorb the fuel shock without adjusting guidance, Scenario 1 has traction. If guidance moves, Scenario 2 is no longer a tail risk, it is the base case. The iron ore giants are not broken, but this week's events reveal that the margin of safety everyone assumed was built into the majors may be thinner than the dividend yield suggests.